All right, let's go ahead and get started. And first of all, thank you for joining us this afternoon. Really appreciate it. We've already had a very exciting day here at the Cornerstone home office in St. Louis. We had a pipe burst earlier with our sprinkler system, and the fire alarms went off, so we all had to evacuate. That was about an hour ago. I was really worried what this webinar was going to look like. I thought I might be sitting out in my car doing it from my phone, but fortunately we're back in the office and we'll continue the excitement with the webinar today. I'm Bill Friebel. I'm the president of Cornerstone Wealth Management based here in St. Louis. We have a great webinar today with Dr. Jeffrey Roach. He's the chief economist from LPL. Before we get deep into the content today, which is really what you're here for, I always like to give just a brief introduction to really who is Cornerstone, because there's a very strong possibility that you may not know who that is just based on how your advisor is branding themselves or presenting themselves. So just to give you a little bit of who Cornerstone is, the firm was founded in 2005. We have over 120 advisors scattered throughout 15 states, which you can see on the map on the screen. We have a little over $7.5 billion in total client assets amongst those financial advisors. And all those advisors came from 17 different firms, really on their journey to become an independent financial advisor. That being said, the reason why you may not know who Cornerstone is because your advisor brands as something other than that. You'll see many of the brands on the screen here. You'll see Triada Advisors. You'll see Stone 8 out in Washington State. You'll see Steamboat, you'll see Legends Financial, you'll see Stotler Wealth Management. So again, your financial advisor might be branding as something other than Cornerstone, but they all still fall under our umbrella. Now, all of us are doing business with LPL. LPL is our broker dealer. They're the largest independent broker dealer in the country, with over 21,000 financial advisors and $1 trillion in total assets. But I think one of the most important things you should see on the screen there is that big zero in the middle. Part of being an independent advisor and part of the attraction of advisors becoming independent is they don't want a home office really telling them what to do. So there are 0 proprietary products that LPL is trying to tell their advisors or incent their advisors to sell to their clients. It's really just the financial advisor finding the right fit and doing the right thing for their clients. Now, how does this all fit together? Well, you, of course, are working with your financial advisor locally, but when that advisor went independent, they may have wanted a little bit more support and structure and scale. So they plugged into a firm like Cornerstone to really help them scale their business and run their business in a more efficient way. That being said, this webinar is an example of that. We do a lot of the heavy lifting for that. The advisor just sends the invitation out to you, and hopefully you find value from it and you join us like you are today. As I mentioned before, LPL is the broker dealer, so they not only have the inventory of product, but they prepare the statements. They also have a research team, which is what Dr. Jeffrey Roach is a part of, and he'll be sharing a lot of his thoughts today. So again, they're providing a lot of infrastructure for that advisor as well. So what that ultimately means for you is, frankly, more time for your advisor to sit in front of you and work with you, as opposed to trying to work on their business. And obviously we think that's a win-win for all involved. If you do want to ask questions, I will be interviewing Jeffrey Roach today. But if you have questions that I haven't answered or asked, the way you do it is you send an email to cornerstonewm, all one word, no spaces, no periods in the middle of that. So cornerstonewm@lpl.com. Once again, cornerstonewm@lpl.com. And let me stop sharing my screen. And let's get right to it. I am very excited to have Dr. Jeffrey Roach with us today. We were supposed to have him a year ago at this time, where he was going to be sharing LPL's thoughts on markets. And if memory serves, I think you had some sort of travel delay. You're in high demand this time of year, and I think there was a flight delay or something happened, and unfortunately you couldn't make it. But we're really excited to have you here today. I just wanted to give a little bit of your background because I do find it very interesting. Very regularly, if you had an economist come on or we were speaking to an economist, they would probably have a PhD in economics. Well, check the box, you have that. They might also have a background in mathematics. You have an undergrad in mathematics, so check the box on that. But what I find to be very interesting is prior to joining LPL, you were with Visa. And if being an economist for Visa, I would have to think that you probably have some of the best real-time data about what's going on in the economy, because you're seeing on a daily basis really what people are spending money on, and how they're transacting business, and if it's growing or if it's contracting along the way. So I found that very interesting. The other thing is, sometimes you get these economists and, it's just talk about the economy and, no real world consequences. You were a portfolio manager of a five-star mutual fund as well. So, you've had to put this background to work for you and actually manage money. And I think that's just such a great foundation to bring to what you're doing for LPL. And I think that's also going to be great for what we're doing today. So, Jeffrey, what do you say we just hop right into it? And I hit you with probably the main question that's on everybody's mind.
Yeah, that sounds great. And Bill, it's fantastic to join you. I am calling in here from Charlotte, North Carolina. One of our LPL offices is just across the border into South Carolina, and it may be just a few degrees warmer down here. I'm not sure how much, but maybe a few degrees.
Well, you let me know if you have any pipes burst during our conversation. If you need to run, we can figure something out. But I want to start with that question of recession. And I think that is probably the main one that's on everyone's mind. And just to give a little bit of a backdrop, so we have higher interest rates, but consumers have still continued to spend. GDP numbers have actually been surprising to the upside as of late. The job market is still tight. Corporations overall have been posting, decent and in some cases strong earnings. So given that backdrop, are we going to see a recession in 2024?
Wow, great question. And I always answer that straight up. I'm not like your typical economist where I'll dodge the question. I'll answer it. But I will say that after my answer, it always needs to be connected to real-time capital markets. What does this mean for the markets? When we talk about the economy, we need to talk about Main Street. Wall Street and Main Street sometimes intersect and run in parallel lines, but Wall Street and Main Street are not the same street. So recession, I think 2024 is going to be a year where we'll see a recession. It's not going to be like any other. And if we had to find one where it would be like, maybe it's like the 2001 recession where we had negative growth in the first quarter. Now, granted, we're talking pre 9/11 here. So obviously that's such another analogy, another story altogether, another set of circumstances with the terrorist attacks of 9/11. But earlier in the year in 2001, in that period, 2000, 2001, all those quarters, we had a recession that lasted one quarter. And then the economy grew again a quarter, then contracted. So it's a notion that we have to remind our end clients that we have to be really careful with this notion that a recession is 2 consecutive quarters of negative growth. You could have a recession with only 1 quarter of negative growth. And on the flip side, you could have 2 consecutive quarters with no recession. In fact, we had that in 2022. In fact, a lot of people started to, debate saying, hey, maybe the numbers are off or cooking books or some conspiracy theory. I like to tell folks, remember, we have had 2 consecutive quarters of negative growth with no recession in a time period that is very similar to where we are now. So I think this is a little bit of a footnote. We could dig deeper if we want to, but I think in many ways, you got to go back to 1947, by the way, to get 2 consecutive quarters of negative growth and no recession. But I think if you know your history, a post-World War II economy, I think can inform ourselves very well about a post-pandemic economy. Think about post-World War II. Capital and labor moving all over the place, right? A lot of people were sent out of the labor force to fight. We had a lot of a spike in women labor force participation rate. Then after the war, 47's after the war, 48, those years you had this shift the other way. A post World War II economy eerily similar to a post-pandemic economy, given the gyrations of both labor markets and capital markets. Again, that's a little teaser. Maybe we can dig into that a little more. But yeah, 2024, I think a recession seems to be likely, not a guarantee, and certainly like not your normal recession that might last a little bit longer and a little bit deeper. Again, the analogy from the early 2000s of just one quarter of down 1% and some change. That's that. I'll leave it at that. We can drill in some more if you want to.
So I think you gave me a great segue to drill down a little deeper. And I always like to pull out some of the buzzwords that investors might be hearing out there when they're watching a financial show on TV, or maybe they're reading this or they see it on the internet. And one of those new terms, and I say new terms, I certainly had not really heard this one before, but we're hearing about a soft landing. And me trying to be a student of history as well, I've not seen that we've ever, in fact, had a soft landing. So is that much more of like what you're talking about when you say a recession like no other?
Absolutely. So a recession has three necessary ingredients. And they all start with D's actually. So I've actually blogged about this, the three D's of a recession, and that is depth, diffusion, duration. Meaning, to get a recession, you have to have some depth of contraction. It doesn't have to be crazy, but it has to be some kind of decline. It has to be a negative number versus, just flatlined. Depth diffusion, this is what we did not have in 2022. Diffusion means that it has to be across most of the sectors, if not all the sectors of the economy, meaning you can't have really strong consumer spending like we did in 2022, but really bad inventory growth and bad trade numbers, which pulled down growth, overall growth. That's not a diffused experience, the diffusion. And then duration means it has to last more than a few months. Doesn't have to last a long time necessarily, but long enough for us to say, okay, the contraction is in the business sector. It's in the labor market. It's in consumer spending. It's in, the bond market, that kind of thing. Now, going back to your first question about a recession in 2024, it's really interesting to note that recessions don't always coincide with massive sell-offs in, say, the S&P 500. We actually had a really strong January in the early 2000s when we had that one quarter of negative growth. Markets are choppy. That's the right way to think of it. Markets are choppy in a recession, not necessarily negative in a recession, which, by the way, as you rightfully pointed out, Bill, here at LPL, we are agnostic to product. We are a broker dealer and we're a research team that looks at markets. And we do manage money for our clients, but we don't sell anything. The point is we're not trying to tell you what to do in terms of product, but I will say in periods of choppy markets, it really does call for clients to have someone to walk alongside with them, meaning don't do it alone, right? Because it's not easy, right? If it's choppy, it's not just straight up. If the markets are low volatility and straight up, you just put your money in an index fund and you could be okay. In choppy markets, I think calls for professional advice. I think that's the values, Bill, as you have been in the business, knowing that you provide that ability to walk alongside with those that are long-term investors and looking for opportunities to be active in the markets. That's what choppiness calls for, and choppy is typically what you get when you're in economic uncertainty or even a downright recession.
Yeah, that's great advice, and appreciate you saying that. I know all of our financial advisors appreciate that as well. As they walk alongside their clients through, not just this year, but the years ahead. I do want to jump into interest rates and just the interest rate environment. Yeah, the Fed, and this was really true of really all central banks around the globe, at least in developed markets last year, they were all raising rates to deal with inflation. The market now seems to be anticipating, and here again is one of those other buzzwords that I wanted to bring into our discussion. The market is anticipating the so-called pivot, where the Fed will start to go in the opposite direction and start to cut rates. What I find interesting, and I haven't looked in the last couple of days, but a little bit earlier in the year, the Fed futures market was predicting 5, maybe even 6 rate cuts in 2024. The Fed very quickly came out and said, no, 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 maybe 3. So who's right? Will we see 3? Will we see 5 or 6? Will we see less than that?
Well, the Fed always is going to talk a little more tough than what actually happens. I like to tell people, back in 2015, this is the most egregious example, but it happens all the time. 2015, in their summary of economic projections, where they say, hey, this is what we think about inflation and the job market and then growth and interest rates. In those projections, they actually say that rates are going to be, up to 3.5%. Of course, in 2015, coming out of a great financial crisis, rates were still very, very low. They said, hey, 2 years out, we're going to keep tightening and tightening. Well, they actually did the exact opposite, much lower, and in response to some challenges, particularly in trade, some of the geopolitical risks, even as we saw during the years after the great financial crisis. The point is that the Fed often talks tough. Reality is rates are often softer. I think the truth, when you ask Bill, who's right, markets or Fed, I think the answer probably is neither. The truth is somewhere in between. And so investors are very interested if we get that soft landing. You asked me about that in the previous question. The soft landing just means the Fed can slow inflation without anything breaking, meaning they can tighten up policy, make it less accommodative, a little tighter, slow housing market, slow capital expenditures, slow borrowing, slow it down, but not so much to the point where businesses start laying off people, unemployment rate rises. So that soft landing refers to the ability of the Fed pivoting from hiking to cutting without really, really bad things happening in the economy. So far, here we sit, January 17th, we have the latest job numbers for December. We have a number of stats, at least survey numbers, how businesses and purchasing managers and CEOs are feeling about 2024. So far, there isn't going to be, or hasn't been, too much pain. Jerome Powell, the chair of the Federal Reserve Federal Open Market Committee, the FOMC, that's the committee that actually sets the rates. He talked about potential pain about a year and a half ago. And that's why you'll often hear those of us in the markets respond and reference that. So far, we haven't seen a lot of pain despite a very aggressive rate hiking campaign. So specifically to your question, who's right? Well, I think the Fed will start cutting in March. They're meeting at the end of this month, by the way. No change there. We'll get some more clarity on their thoughts. By the way, 2 o'clock Eastern time today, the Fed's going to release their beige book, and I'll be blogging on that right after I end our conversations with you, Bill, on the beige book. We'll get some clarity on their thoughts there. But first cut possibly in March, and we'll have a few throughout the year. Maybe not, rates going all the way back down to say 3.75, but I think 4.25 is very reasonable. A full 100 basis point or full 1% decline in Fed target rate is very reasonable, and maybe a little bit more approaching 4%. But I don't think it's going to go below 4% by the end of the year.
Let's talk a little bit about inflation, because again, that's why rates went up. Was to deal with inflation. Inflation has been trending down. That's a good thing. But we often hear about the Fed's quote unquote comfort zone of around 2% inflation. How soon do you think we'll get back to that? And maybe to expand on that question a little bit, what are some of those areas of inflation that seem to be persistently sticky and staying a little higher?
Right, right. So inflation is really a difficult animal to try to put in its place, because inflation impacts households very differently. And it when I take my economist hat off and put on my just plain old human hat, good neighbor kind of hat, it's very evident that upper income folks, perhaps you could even say white collar versus blue collar. White collar folks work from home, the ability to do hybrid work. Uh, in some cases, those that have been in the labor force long enough where their income is stable enough, they have a home, they perhaps refied in 2021, got low rates. That's a very, very different experience. Their inflation experience is very different than, say, someone, just out of college, or maybe someone who owns a restaurant, someone who is in the services industry, rents. It's very, very different. And so I am always very, very quick to say the inflation story is two very, very different stories, depending on who you are. By the way, just one quick personal interest story. For me personally, my inflation rate, well, let me tell you first the punchline here. I moved from Silicon Valley in early 2021, negotiated, bought a house end of 2020, moved from Silicon Valley to Charlotte, North Carolina in 21. My personal inflation rate is, say, negative 1,000, right? Moving from a very expensive area to a lower cost of living area, relatively speaking. That's not everyone, but it's enough. The people enough, that experience was pretty broad based for those that could take advantage of hybrid work and maybe even work remotely and things of that nature, where the inflation story is very different than something else. The reason why I say all that really impacts, I think, markets, how capital is being moved around in the economy right now. So you ask about inflation. Inflation is clearly trending downward. Uh, Even if you look at the broadest of all measures, I think we're going to hit that 2% target by at least, say Q1 of next year. We'll get very close to 2% by the end of this year, I think. Um, but my story about Silicon Valley to Charlotte explains, I think, why you might see, for example, this morning, restaurant spending during holiday season in December was amazing. You might say, wait a second, we know menu costs have gone through the roof, grocery bills gone through the roof. What gives? Well, what gives is you have this massive rotation, and it allows a lot of people to have some a little bit more discretionary spending. So inflation is trending the right way. I think the Fed's really happy in a good spot about that. And you got to look under the hood, look a little bit deeper, and you might have a really good reason for what you're actually seeing in the economy.
Yeah, I think that's such a good point about everyone kind of having their own inflation rate. If you're later in life, it might be all about healthcare costs. If you're younger, as you said, it might be rents. If it happens to be you need to buy a car this year, it may be autos. So that's a very, very good point about really where that inflation is hitting your pocketbook. I want to jump into geopolitics. Needless to say, we have a lot of things out there to talk about. I hearken back to this time last year, and all we had to worry about was Russia invading Ukraine and some concerns over China invading Taiwan. And I don't want to make light of those areas. Obviously, those are big concerns, especially to the folks living there or who have loved ones there. But now we can add to the list Israel, Hamas. We also now have the Houthi rebels backed by Iran who are attacking some shipping lanes, which is potentially adding to inflation of some goods costs along the way. What are some areas that you are most concerned about from a geopolitical perspective coming into this year?
Well, I think we can learn from history on this. We know, the oil embargoes of the 70s, the challenges in the 80s, Iran conflicts, 90s. I mean, you just go through it each decade, and each decade has had its problems. What's fascinating to us at LPL Research Team is that at this point, markets are shrugging off a lot of those, shocks to the system. You think about, you're right. You think about last year, concerned about Russia, Ukraine, concerned about the breadbasket of Europe. We were concerned about natural gas prices in Germany when there was, a cold winter, and just the cost of living, particularly in the UK as well, not just Germany, but the UK. And 3 weeks later, it was, it was an old story. Wasn't really relevant, wasn't really moving markets. And so these geopolitical events are kind of a no story until they are. And that's the challenge, and that's really the reason why you have to look at higher frequency data to to identify, okay, when will markets really care about this? At this point, they don't care. Markets, we talk about markets, are dispassionate entities that, they don't have feelings necessarily, right? I mean, I guess you could argue, maybe a personality of markets, but all that to say is, there is shocks that markets tend to move past, and at this point, if things kind of stay as they are, uh, horrendous for those that are living in those regions. But it's really interesting. It seems like there's not a major scare necessarily showing up in capital markets, but we are certainly monitoring that and ready to react when that those changes in events happen.
I want to mention commodities in the context of geopolitical issues. And by the way, the LPL Outlook that you've referenced a couple of times, that is available so anyone who would like that, please reach out to your financial advisor and they can get that to you very easily. But commodities got special attention in this year's Outlook, and really it was in the context of geopolitical issues. And I want you to maybe share with the folks who are joining us on the webinar today, why are commodities worth paying attention to, but then also what are some of the longer term trends that you see in the commodity space?
Yeah, yeah. So commodities, back in the day, were relevant from an alternative asset class. We don't often think of it that way anymore, right? So, in previous time periods, you have your debt, equity, and then cash, and then alts, your alternative space. And within that is, precious metals, your gold, silver, your oil exposure, energy sector exposure in general. And then as things developed in more recent time periods, opportunities to have access to managed future strategies and global macro strategies, all of these areas. I think the reason why we think commodities are important to think about is its relation to the alt space. And so when you think, it goes back to one of the first questions you asked, Bill, about the recession, about what the risks are, and my response was, well, choppy markets. That's something you have to prepare for. Because of that, the natural progression of thought as a money manager, thinking about portfolio allocation, where do you put your money? The natural follow-up question is, well, okay, if we got choppy markets, where do you hedge, or where do you find some kind of ballast to the portfolio that's in your alternative space? And that's why commodities matter. Generally speaking, though, I think, it's interesting as we see the global economy have a little bit more headwind, slow down, perhaps even more dramatic than the US. I think energy demand might actually wane a little bit in 2024, but that's something to prepare for, and find alternative opportunities. One thing that's interesting is kind of a somewhat of a strange factor, outside of energy space and the rough commodities, thinking of precious metals, just shocking when you think, okay, Costco, at least around here, I don't know if it's across the whole country, but you heard the story, Costco's selling gold bars. That's the kind of, um, I guess the main street demand to have an alternative asset class that provides some stability. Now, I'm not quick to support having physical gold. I personally I like non-tangible assets. You don't have to worry about storing, right? The storage costs. I don't want to have to worry about the storage costs and all the risks that are associated with that. But when you think Costco selling gold bars, um, that might be going a little extreme in my world here.
Well, you can pick up your gallon-sized mayonnaise jar along with your bar of gold. I guess that makes just for convenience, right? Jeffrey, I am not sure if you're aware of this, but we do in fact have an election coming up this year in the United States, and a presidential election at that.
I
And
wish I wish I weren't aware of it. I think.
yeah, and obviously, we don't know with 100% certainty who the candidates will be. I think we probably have a rough idea of what that's going to look like, but I want you to maybe talk to the investors or speak to the investors about how they should be viewing that, what lens they should be viewing that through as it pertains to their portfolios.
Well, I can't remember if we have this graph in our Outlook or not, but we've definitely blogged on it. We've definitely written on it. So you can point your clients to lpl.com, and there's a drop down right at the lpl.com main page for research. Under research, you'll be able to find our writings. One thing that we have been encouraging folks to think through is they think about how to allocate in 2024, and that is what markets do in those re-election years. And election years tend to start slow, but it's interesting to see that going back to the 1950s, markets are up low single digits during those, well, really kind of mid single digits during those years, and that's when you break out and adjust for reelection and Democrat Republican. It's interesting. I wonder one narrative around that could be that we're a hopeful people, right? So change could potentially provide some opportunities for growth. I think part of the reason, of course, when you think about not just election years, we've blogged on this too, by the way, what I'm about to say, when there's a divided Congress, there's often a market that responds favorably. And I think that can be a little easier to explain because you think, okay, well, maybe there's some, uh, you know, protection from extreme moves in either way, right? Wherever you sit, if you're sitting on one side of the aisle or the other, there's a healthy guide rail that protects, Washington from getting way off the track. I think where I'm a Milton Friedman kind of economist, and I love seeing when there's pro growth policies and when you can support particularly entrepreneurship. This is a whole can of worms. Maybe we can go down here if we want to, but as the labor force shrinks, right, and as more and more people are now relying on the rest of us to work, right, more and more retiring, the number of retirees as a percentage of the whole population, we have to have another spike in productivity. Hence, the AI kind of conversations, the artificial intelligence, anything that's helpful for productivity. And again, entrepreneurship, how do you get in an environment that supports creativity and innovation? That's exactly what we need in this time of our country's history. And that would be one way to kind of put a lens in how we think markets might respond depending on who's in and what the hot topics of the day are. I'd love to see a real push toward rewarding innovation, creativity, entrepreneurship.
Yeah, it's such a good point. And given your background at Visa, I always think it's good to remind investors that regardless of who gets elected, I have to believe that whether it was Republican or Democrat, the CEO of Visa didn't say, "Okay, our guy didn't win, we're shutting down." they have to adapt to what's going on. They have to adapt to the regulatory environment, and their job is to grow that company. So, that doesn't necessarily change how they operate. One last question on politics, and then I want to get into some thoughts on markets to close out the day. But we are facing a potential government shutdown next week. We have both houses of Congress sort of negotiating on that right now. But I will say one of the broader questions that our advisors often get from their clients centers around debt and deficits and the longer term implications of that. And we could probably spend an hour on just that topic, but let me give that one to you and just let you chew on it for our viewers today.
Yeah, that's right. So certainly, thinking about what the composition of the labor force looks like over the next, decade or so, as I just referenced earlier, thinking about what borrowing costs, debt issuance from Treasury, et cetera, et cetera. I think we're in a really unusual spot where, given the fact that inflation's kind of slowed down, right? And the Fed has that ability to say, okay, we can kind of pull back how aggressive we were in trying to tighten, ending quantitative tightening. In essence, they're in a spot, and rates will be in a spot where the doomsday scenario is less likely. So I don't know if you were tracking some of the doomsdayers. I shouldn't even say they were doomsdayers, but they definitely had the more negative view of things, saying, hey, by 2030, the amount of interest payments that we're going to have on our debt, is just going to be astronomical. Well, that's assuming the very worst of the worst, that the Fed was going to keep hiking. We'd have Fed funds rate at 7% or, something like that. And so clearly that would have ripple effects all the way through. In reality, as I already said, with projections for this year on rates and inflation, we're at a point, I think, in time where those projections, those worst case projections on, interest payments, even though debt is growing, it's not going to be as bad as it could be. What I like to do when I think about the scenarios that you can play out with debt issuance and interest rates and the way that the government mismanages things, I like to go back to early 2000s. We did have a brief federal surplus, very briefly, in the early 2000s, and we got there because of strong growth in the late 90s. Think about internet age and the efficiencies gained from better power computing, et cetera. So that it ties into your previous question about what should we think about in terms of the upcoming elections. We have to see something recover, particularly growth. Our growth trajectory has to improve, which it actually looks like it might, say 2026, going through the soft patch of 2024. The best way to deal with deficits and mismanagement is for an economy to grow. So we talk about cutting taxes, we talk about cutting spending. Both have their arguments, both are important, powerful, but the best bang for your buck in terms of managing a government's budget balance sheet is having strong pro-growth policies. You grow out of those problems faster and better than you would if you provided, from the government stimulus standpoint, provided maybe artificial help. Pro-growth at the small business level, even at the larger business level. But that's the kind of thing that you have to see to manage and steer away from the doomsday scenario. And all that being said, I will put a plug again. One of the reasons why we're slightly overweight domestic markets relative to what we see in Europe, Latin America, China, is because the U.S. has, and it, maybe I sound partial, but the U.S. has this ability to educate well, right? People come here, maybe not on the primary grades and high school grades. can't compete math scores with the Koreans, for example. But when you think about graduate school and technical training, where do people come for med school? Where do people come for law schools? We have a good set of property rights, right? Legal systems very important to having an economy grow, and we are overweight U.S. at this point because when there's uncertainty, it's always the U.S. that tends to outperform. You think about that in previous cycles. We see that after the Great Financial Crisis, for example.
You gave me a great segue. I wanted to close out and talk about markets and what that means for portfolio. So let's just a quick recap of what markets did last year. So you had the Dow up 13.7%, the S&P was up 24.6%, NASDAQ was up 43.4%, the MSCI World Stock Index, so foreign stocks were up 22%. The Barclays Aggregate Bond Index was up 5.7%. So great year. Generally anywhere you were, you probably had a pretty good chance of making money. So that's wonderful. So far this year, we're down around 1% on all those previously mentioned indexes. LPL in your outlook, you did put out an S&P range, a year-end range of between 4850 and 4950. Based on where we closed out 2023, that would be somewhere between a 2 and 4% return for the year. It really doesn't sound very exciting based on what we had for last year. So what are some of the factors that you see limiting the stock market this year?
Well, if you look at the headwinds that might show themselves, say the first half, maybe the first quarter, second quarter, that provides the scenario to say, okay, there might be some downside in the near term. However, if you think about the setup for the rest of the year, you could have some fairly decent growth. So you could say, okay, we're not going to have, it's not a real straight linear kind of experience, right? From Jan 1 to the end of December. And we've talked about this in our internal investment committee meetings, thinking about, okay, well, maybe we're a little bit low on our estimates. It's probably, I think we would probably be able to defend, closer to a higher single digit number for the year. Not a repeat of 2023. We don't see that in the cards, but we certainly see most of the growth in capital prices. The way that things are pricing in. The latter half of the year would be where the engine is going to really be able to push things up. So maybe 7 to 8% returns by the end of the year. I think that might be a little more reasonable, given the fact that we might see some of the headwinds dissipate as the Fed continues to talk toward cutting. Maybe they do cut more than they say, and maybe markets are a little closer to the truth. Then S&P could be even higher.
Well, and really, if we get that, even at the higher end of that range, a 4% return, that's just price return. You throw in 2% for dividends, and you're at 6. So you get there pretty quickly, total return. So
that's an excellent point to remember. Yeah, that we need dividends matter, right? Dividends matter a lot these days.
No doubt, no doubt. So you mentioned the Fed cutting rates, and that gives me a great opportunity to ask this next question. Could we see a year in 2024 where bonds outperform stocks?
I don't know if we'll see them outperform, but I do think it's an opportunity to say, all right, all the cash that's sitting there, earning a decent return, it's probably worth putting some of that cash to work in both equities and in bonds. And core bonds do seem to be doing, is setting themselves up for 2024 to be a little better of a year. Maybe on the shorter end, you don't want to push duration out too far, but as the Fed is cutting, you could see a maybe more normalized yield curve, and that could allow bonds to truly act like bonds again and have a little better of a year. Not sure, again, if you add in dividends, not sure if it would necessarily outperform stocks, but certainly outperform cash.
Yeah, that's such a great point. It's been great for investors to enjoy those higher money market rates. It's been great for them to maybe put some money in a 2-year, 3-year CD and get a pretty favorable return over that period. But of course, both of those come with reinvestment risk. And
Yes.
when you start to think about where that money is going to be put after that, what are some areas both in the bond market and in the stock market that are the areas you favor?
Yeah, so we wouldn't go necessarily high yield. We would look at your core bonds, and maybe even on the a shorter end as the Fed cuts. Then from the stock side of things, it's interesting. Even though the Mag 7, as we talk about it, the main support last year, we could really see tech continue to show some strength even in 2024, even after a very hot year. So I think, when you think about how tech has often acted like a growth and a value type stock, meaning you could argue for tech in a really strong cyclical market where you're kind of recovering, or in another stage of the cycle, tech could still be a decent sector for allocators. So core bonds and tech, I think, are two very, very attractive areas to consider even as we look through 2024.
So I have just really one kind of broad question. You can take this any direction you'd like before we open it up for Q&A for our participants on the call, which, by the way, again, if you would like to ask a question, if there's something we've not covered, please send an email to cornerstonewm@lpl.com. Again, cornerstonewn, no spaces, no periods in that, at lpl.com. And I'll share those with Jeffrey as soon as I get them. So again, very broad question. Is there anything that you would like to leave long-term investors with as we head into this year? Just it may be a New Year's message to them, or just how they should be thinking about their portfolios.
Yeah, well, a couple things. That's great. I would often encourage folks. I encourage my family this way. We need to think of ourselves as investors, not traders. So yeah, I started my career on the trading floor at Bank of America in 2004, right after finishing up PhD work at Clemson University, and great way to learn the markets, learn economics. But we're investors, we're not traders, and that's very, very important. A host of ramifications on that, but I'll just leave it at that. That's something really important. And then I think also don't underestimate the creativity of the American business. I think that's another point that we've seen time and time again over the various different business cycles, different periods, different pressure points in history. Don't underestimate the small business, the mid-sized business in this country, and I think that's another key takeaway here.
I do have a couple of questions that just came in, and I think we've to some extent addressed this, especially as we've talked about the stock market and the bond market and areas for opportunity this year. But yeah, this I think got a lot of press. I know there were plenty of these discussions on financial media outlets here and there, but we heard over the last especially 3 years, as interest rates were going up, as a result, bond prices were going down. You had a very difficult year in 2022 for stocks. And we started to hear a lot about the 60-40 portfolio. So 60% stocks, 40% bonds. But the 60-40 portfolio is dead. And that was the question that just came in from one of our participants today: is the 60-40 portfolio dead?
Well, it's challenged. It might be dead if you're thinking index funds. It's not dead when you think about looking at some and using some of the active managers. And I'll illustrate it this way. It's just like I said with inflation. Inflation, you got to look under the hood. Who's feeling the pressure? Think about another analogy I'll share that illustrate the 60-40 scenario. Think about housing in the last 2 years. And even particularly in the end of last year, going into where we are even right today, two very, very different experiences. Existing homes, not much supply, median price hasn't done much. Activity in existing homes, came screechingly low, not much recovery there. New homes, very, very different story. You got Pulte and DR Horton Lennar offering their own financing for mortgages, right? So people can come in. Building is strong, particularly in the multifamily. Condos are condo construction, everywhere. So you have these two very, very different scenarios. So you might say, hey, don't invest in residential real estate. Well, it depends on where. And it's very, very different depending on where. So same thing. Oh, 60/40 doesn't work. Well, it depends on where you and how you're allocating within that 60 and within that 40. And I think that's where I think again, it kind of calls for having a professional walk alongside an end client to think about ways in which you can get a mix of equity and debt and alternatives, have that portfolio mix, but do it in such a way where you're adjusting to really what's going on underneath the surface. And that's really the key there.
Yeah, so important to be walking alongside, with your financial advisor to not just adapt to the things that are happening in the economy, but the things that are happening in the investor's life, because that can really dictate that mix as well. So great point there. One last question that I have, and you will have to put your Karnak hat on, I think, for this one, because it's certainly looking out into the future. But we talked about debt and deficits. We talked about, again, these kind of high levels of spending that we've had here in the last few years. A lot of that was pandemic spending, but the question was really about tax rates. And we're at historic lows on taxes. They are set to go up if nothing is done in 2026. So undoubtedly, there is the possibility of that on the relatively near term. What are your thoughts on taxes, both near term and longer term, as it pertains to the U.S.?
Well, I think we have become in this country, and this is maybe a little more the more of a sour note than I said earlier about never underestimating the creativity of businesses in America. We have become more like Europe, more like Japan, right, in terms of the size of the public state. And so I think in many cases you could argue that the tax rates will indeed be higher for the next generation as we sit here. For my kids, they're going to have higher taxes to deal with for a number of reasons. But I think the demographic reason, the size of the public sector, and I think just the way in which a developed economy ages. We're in that eight. We're not emerging. We're not semi-emerging, right? We are truly an aging economy, and that's certainly going to, I think, push tax rates up certainly in the next 5 to 10 years.
So for the investors who heard that, that I think that tax equivalent yield on your investments probably becomes that much more important. So certainly be talking with your advisor about municipal bonds, other tax favored investments that take advantage of the tax code, or at least allow you to be a little bit more tax smart. It would probably be a good thing. Well, Jeffrey, I can't thank you enough. This was great. Really appreciate you taking the time. I know this time of year is probably when you're in most high demand. You're always in high demand, but we really appreciate you carving out some time for not just Cornerstone, but all of the clients as well as our advisors today. And just really appreciate it.
Well, take care. It was a pleasure to be with you, and hope you have a fantastic rest of the week.
Same to you. Take care. Bye-bye, everybody.